Hey guys, KIT here. I feel like I'm on a roll, especially getting some early feedback from PSAM. So I'm just gonna quickly do a video on why invest 100% of my stock money into XEQT. But before I do, gotta emphasize once again, I'm not a financial advisor. It's not financial advice, but I do want to share with my viewers everything that I do in the financial space so that they're aware of all the options that they have. So like the theory behind having a diversified portfolio is that in the long run, as you can see here with the S&P 500, the stock market as a whole has gone up, largely due to capitalism. So if you believe that capitalism will continue, then you can have pretty much, I guess, blind faith that in the long run, stocks will go up. And that is why I invest in XEQT. XEQT is an ETF that contains 9,268 different stocks. So that's like super diversified. If you check its holdings, it has Apple, Microsoft, Real Bank, Amazon, TD. Again, it has a lot of these banks, a lot of dividend stocks that I talked about in my last video. My last video was just talking about like you don't need to slant your whole portfolio towards dividend stocks. Like this one includes a bunch of these banks that are considered safe by a lot of people. But by being diversified, you're just trying to capture the return of the market that like the S&P has had returns between 8 to 12% over its recent history. And you want to be conservative. You want like 8 to 12% is pretty outstanding. Like I would be happy with that. So, a lot of people want to be conservative and hope for like a 4% from here on out long term. But that's why you are diversified. And the cool thing about XEQT, these are like newish type of ETFs where they rebalance automatically so you don't have to do it yourself. What that means is that if one sector is doing way better than another, it will like shrink its exposure and spread the funds to other sectors so that like you're not overexposed to one industry where if they have a very bad year, you get crushed. But even with that, someone back tested these ETFs, and in the last 25 years, you could have a negative 30% year. That's going to happen, which is why a lot of people talk about how a lot of investors they miss out. They miss out when they're not patient enough or they can't hold for the long term. And a lot of advice is you have to not check. If you're the type of person that's going to panic sell, then you probably want to be able to set and forget. Now, this is a strategy I recommend anyone just starting out. I mean, you can stock pick, you can start stock picking and watching a bunch of different YouTubers telling you what to buy. But starting out, and this is what I did. When I started out late in the game. I started out in late November of last year was my first deposit, and I was shoveling money into it just to show that I back up, I do what I preach and everything 100% into XEQT. Now, I have nothing wrong with people taking shots because there is academic research or papers done that you should be taking shots, more riskier plays. And this might sound counterintuitive if you have less money to work with, especially if you have an income that can replenish that small amount of savings. Because let's say you follow my strategy, but you only have $10 or $50 to save, that annual return isn't going to add up to a lot. And that's why there is reason to want to risk take. I'm talking about poker speak a lot, so that you hit an amount where the annual return makes a lot of sense, which is why some people want to have a less diversified portfolio. By having diversified, I have 9,000 stocks. The range of returns are going to be quite narrow because I'm going to have all the stocks that did well that year and all the stocks that did poorly. But of course, with higher risk, comes like things that could go really wrong, like Tesla stock. You could be one of those guys that invested over here and then became a millionaire when it shot up here. But then you could also be someone that invested at the top here, near the top, at the beginning of the year, and then lose roughly 30%. So that's the thing. Like if you're gonna be less diversified, you're going to be really risky. Your returns can be really high or really low. And there's other ways of increasing risk that I might talk about in other videos, like margin, investing on margin and stuff like that. But all that to say is that even if there is incentive to be risky, but and as you get richer and richer, um, there is incentive to just cap. Now I understand why there's incentive to preserve your capital, to not even go even richer. Because let's say at some point, crazy amount, your annual return is basically more than a salary you would have made. There's diminishing returns of being more rich. Like you just want to, you're just happy maintaining your style of life. You don't really want to lose it all just to earn a few extra bucks. That said, leave any questions and comments. And if you're a friend or family member, you can just hit me up. KYT out.